we moved from the known to the unknown. So we can be able to wrap this over here, and then we deal with already what we've already been covered, so that I can be able to have at least space based on these two boards to cover the content we haven't covered. So to start off, I can start over here by looking at the present value of growth opportunities. Present value of growth opportunities. Here we are saying it is PV go. That. And how to explain the PV go? We are saying that would it be better for a company to pay dividends when it is early in its inception, or wait and retain the earnings and pay up the dividends to the investors when the company assets has actually increased in value? So putting it visually over here, would it be better when a company has actually started like that, moved to that stage, that size, and moving on to that size? Would it be better for a company to pay dividends when it is over here, or when the company's assets have actually increased over there? That is what you're saying is the present value of growth opportunities, and it represents an opportunity cost. The formula for calculating the present value of growth opportunities, they're saying V naught, of the value of a share, is given as E over R plus PV go. We've already said what PV go is. So the present value of growth opportunities is provided by that there. So if you're given the value of the share, the earnings, the required rate of return, we can be able to get the present value of growth opportunities. Would it be better for a company to pay, compensate its shareholders now, or early in its inception right now over there, and give them that to the shareholders, or would it wait until it stabilizes and now waits to decide to give them at least a greater portion when the company has actually stabilized there? That is what you're saying is the present value of growth opportunities, like that. So we say where E represents the earnings there. R, we had already defined what R is, required return, and PV go is present value of growth opportunities. There. Now we need to try and see if we've actually understood that concept, and try and see if we have probably an example that we can be able to try and solve for the present value of growth opportunities. An example is as follows. Suppose a share is expected to have an average EPS of 0.79 shillings if it distributed all its earnings as dividends. Its required return of 9.75%, and the current share price is 18.39. So what do we have? We've been required to calculate the company's value of growth opportunities, so the present value of growth opportunities. So let's see what we have. Do we have V naught? Do we have the earnings? And do we have required rate of return? Let's see from the example. So the value or the price of the company is 18.39 shillings, right? And the earnings estimate is how much? We have been given the earnings of 0.79, and the required return is what have we been given as the required return? Let me confirm, 9.25%. Yes, 9.25%, like that. So we can be able to calculate and slot in the values over here as provided. We have V naught is given as E over R plus PV go, like that. So V naught 18.39 is equals to the earnings is 0.79 divided by R, which is the required return. We convert this into decimal, 0.0925 plus PV go. So how do we solve for this? We just first of all divide this over this, and then we now take it on the other side. We don't first of all cross multiply. That one is usually very common in mathematics. So we are saying it's 0.79 divided by 0.0925, and then we get 8.54. So 18.39 is equals to 8.54 plus PV go right there. So now we take this on the other side over there. So 18.39, we subtract 8.54. So how much do we have as the present value of growth opportunity? So PV go is equals to 18.39 minus 8.54. We have 9.85. 9.85. Like that. Present value of growth opportunities is 9.85. So having gotten the present value of growth opportunities, we need to also move ahead and try and look at the determinants of the present value of growth opportunities. The determinants of present value of growth opportunities have been provided in the equation there. The present value of growth opportunities, earnings is one of the determinants. The required return, the market price are the determinants of the present value of growth opportunities. So if you're asked if you have, what are the determinants of anything that has got a formula, the determinants include those inputs that are in that formula over there. So there are times when you could be requested to calculate the no growth opportunities based on the PV go there. So how do we go ahead and look at that? So we say that to get the PE, or a price to earnings ratio related to the PV go, the price earnings ratio is given as market price per share divided by earnings per share. That. So if we read, we can be able to come here and say, since this V naught represents the value or the price, we can say that the V naught divided by E, we divide E on both sides so that we can be able to see the PE ratio that relates to the present value of growth opportunities. So we say that the PE, or in this case over here, we can say V naught over E, which is the same as price to earnings ratio. V naught over E is equals to, we are slotting it in that value, E over E times R plus PV go over E. Now we can see that this E or this E go. So V naught over E is given as 1 over R plus PV go over E, like that. And this PV go over E is the present value of growth opportunities, or the PE ratio that relates to present value of growth opportunities. This 1 over R is the no growth opportunities of the firm, 1 over R. So let me define those inputs there. So we say where 1 over R is the no growth opportunities of the firm. And then we have PV go over E. PV go over E is the P stroke E ratio that relates to the present value of growth opportunities. The PV go relates to that. So it's the PE ratio that relates to the present value of growth opportunities. So you could be asked, what is the PE ratio that relates to the present value of growth opportunities? Now you already have the PE ratio provided to you there. What are the strengths and weaknesses? So we've already done the Gordon growth model. We've already done the present value of growth opportunities. But before we move on to the valuing an on-dividend paying stock, we need to know the advantages or the strengths and weaknesses of the Gordon growth model. Strengths.